So hello guys, so today we are going to discuss about unit number 4. Okay, so unit number 4 is having following topics. Topic number 4.1, which we have discussed last time. It was about different types of expenses and liabilities, in which we discussed purchase commitment, accounting for warranty and loss contingencies. Topic number 2 is about leases, which we will cover in next class. We have income tax and we have accounting for bonds and non-current notes payable. So today we are going to cover about what? Accounting for bonds. Okay. So because this is the most common topic, which is also highly testable in your exam. So there we are moving now. So here we go, guys. So here we have accounting for bonds. So what are the bonds? Just let me first give you idea about it. For example, if you are a listed company, right, and you want to take a loan, so you will have here two options. Option number one, straight away you can take a loan from a bank. This is your first option. Second is what? You can issue the bonds. Okay, and you can sell these bonds either to any financial institution or you can sell to the public at large. But it is the way to take a loan from the company, from the public, sorry. So here, let's understand first what are the bonds, what features are there, what points are there, and then we will move to the accounting side. So guys, here, let me explain first these points, then I will tell you definition. So bonds, you can say it is a kind of certificate, okay, which are issued by a company, right? And this certificate where all terms and conditions are stated. So that is called what? Bond indenture. This is the first word. Okay, so what is a bond indenture? So bond indenture means say the certificate or the paper where are the document where all the terms and conditions are written, that is called bond indenture. Point number 2, so on this indenture, on this certificate, interest rate of the bond is also mentioned, and that interest rate which is mentioned on the bond is called what? Coupon rate. It is also called stated rate. This is the rate of interest which actually company will pay to the bond holder. That is what? On this certificate, duration of the bond is also mentioned, like after how many years the company will take it back from the people and return their money. So the duration of the bond is also called maturity period. Okay. Next, the interest is paid, obviously. Interest is paid at which rate? Stated rate always. And this interest could be paid either half yearly or annually. Okay, so we will talk about how to deal with half yearly interest and annual interest. And next point, the bonds might be secured or unsecured. Secured means because it is a loan. Same like if you're taking loan from a bank, maybe you have to provide certain assets as a security first, then bank will give you the money, right? A bank will lend you the money. Understood? So same here, bonds could be secured, like they might be secured against other assets, or bonds could be unsecured also. Obviously, unsecured bonds are always risky from investor point of view, right? Because if bonds are secured and company is going to default, at least investor has an option, they can sell the secured assets to recover their money. So here we have a different nature of security. Just few points I'm explaining. So what is the nature of security? Number one, we have here which bonds? Mortgage bond. As the words you can see here, Mortgage bonds are backed by specific assets, especially which assets? Real estate assets. Like these bonds are issued against either land or building or both. Understood? Then we have a debenture. It's another word. Okay, in British study, debenture is slightly different, right? But here debentures under American study, debentures are backed only by borrower's general credit. Like for example, if company is taking a loan through the debentures, so mostly you can say it's a kind of unsecured, not secured. So as an investor, you just have to faith. You have to keep faith on the borrower that he will return your money. So these are called what? Debentures. Okay. Then we have another word which is called what? Collateral trust bonds. These are those bonds which are backed by specific securities. Like it could be any other security which is the guarantee for this bond. Okay. Then we have a guarantee bond. What is the guarantee bond? For example, I'm going to take a loan. Let's assume I'm the one company. So you are my parent company. So I'm going to raise a loan from the people, but you are going to give a guarantee bond in case if the first company will default, second company will repay the money. So this is what is called guarantee bond. So what's written here? Guarantee bonds are guaranteed by third party. Example, the parent of the subsidiary, like in the group of companies, one is the holding company, right? So second is the subsidiary company, which is controlled by parent. So parent might also give guarantee on behalf of subsidiary. Okay, so these are the nature of security. Now, if you will look at here, what's written as a definition. So now you will understand the definition in a better way because we are familiarized with the terminologies now. So bonds, what's the definition? Bonds are formal contract. It's a kind of written contract to pay. What you will pay? An amount of money. Amount of money means what? Face value. Face value is always written on the bonds. For example, bonds might have a face value of $1,000, £100, depending on the country, right? Where you are issuing. So here what we have a formal contract as a borrower. The party who is taking money, he is having a formal contract with the lender who is providing the money. And what borrower is agreeing here, the borrower is agreeing that he will repay which amount? Face value. When he will repay this value at the maturity date. Maturity date means a duration. At the end of duration of bond, so the face value will be repaid to the lender. Plus the borrower, what he will pay? He will pay the interest also. At which rate? At stated rate. And stated rate is also called what? Coupon rate. Okay, and interest are paid always at specific interval. Specific interval means it could be paid half yearly or annually. So this contract, the formal contract is called what? The bond. Understood? So these are the certificates which are issued to the public. I hope so you have understood what we have discussed here, right? Now guys, here we are going to discuss important thing after the basic introduction. So there is a first we have note here. We will always calculate the interest on which value? On face value. Actually, what is face value? It is actually the legal value which is written on the face of the bond. This face value is also called nominal value. Which value? It is also called par value. And whenever you will calculate the interest will always be calculated on face value. Now, why I'm using the word only on face value? Because there are different values are there. For example, there could be a market value. For example, there's a bond whose face value is $1,000, but it's trading in the market on $1,020. So interest will not be calculated on market value. Interest will always be calculated on face value. Then guys, here, how you will calculate the interest, right? So this formula you will apply. So you have to take first number of bonds issued. Maybe you have issued, for example, 2 bonds. Then you will multiply with the face value per bond. Let's say face value per bond is how much? $1,000. So this will give you total face value of two bonds, right? It is going to be $2,000, right? And then you will multiply this total face value with what? With the stated rate, which is mentioned on the bond. For example, stated rate is 10%. So 2,000 times 10%, it is going to give you how much? $200 as the interest. Now guys, here also please note, if you want to calculate interest on one bond, so what you will do? Just change the number here. Number of bond will become what? 1 times face value per bond. This will give you face value for one bond and multiply by what? Stated rate. So you will get again what? Interest rate. Understood? So now here guys, please also note, we will always use stated rate or coupon rate to calculate the interest on face value. Why I'm using word again stated rate or coupon rate? Because you might be provided with another rate which is called market rate. Okay, don't use market rate. So whenever you will calculate interest, which actually you will pay, so obviously you will use that interest which is mentioned on the bond, that is stated rate. Understood? Now here we have a small example just to see how interest will be calculated. So how data will be given to you in your exam questions. Number one, for example, a company issues 10% 6 years 200 bonds. Actually, this 10% is the rate of interest and which is stated rate. And this 6 year is the maturity period. And you can see here with this 200, there is no dollar sign. So we'll assume it is what? Number of bonds. And then with the face value of 1,000 each dollar. For each bond, face value is how much? 1,000. And interest is payable what? Annually. So far I will assume only annual. Because what to do with semi-annual interest, right? That I will tell you later. So first we are just whatever we will talk about. We will talk about if interest is paid once a year. If interest is paid annually. So how you would calculate the interest now? So as I told you, you have to apply the formula. So you have to apply first number of bonds. Multiply by face value per bond. This will give you total face value. And then you will multiply with the stated rate. This will give you amount of interest. Number of bonds are how much? We have 200 bonds. Face value is how much? 1,000. So total face value is going to be $200,000. And you have to multiply with stated rate, let's assume 10%. So this will give you amount of interest of 20,000. Understood? This is how you will calculate the interest. First thing we have learned how to calculate the interest. Okay. Now, moving forward. Bonds for issuer. For whom? For issuer. So bonds are always treated as liability. Is always treated as liability. Obviously, the company is going to issue the bonds because they are going to borrow the money from the public. It is their liability to return, right? And for investor, bonds are what? Investments. Investment means to say assets. Understood? First, we are going to cover about from whose point of view? From issuer point of view. Because calculations are same. Either you are doing from issuer point of view or you are doing from investor point of view. Just for one company, it will be a liability. For other company, it will be an asset. For one company, for issuer, it will be interest expense. For the receiver, for the investor, it will be interest income. So first I will cover from issuer point of view. So here we go. So first thing which we are going to talk about now, because we are moving to the accounting side. So here we are talking about bonds payable, which is our liability from issuer point of view. And we are going to talk about what? Initial measurement for issuer. Initial measurement means when bonds are issued, what workings you have to complete, what double entries you will pass. Right? So here we go, guys. So first thing, very first decision from issuer point of view, which you have to take is that should we issue the bonds at par value? Par value means say at face value. Or we should issue the bonds at premium. Premium means say you are going to issue the bonds above the face value. or we should issue the bonds at what? At discount. Discount means say you are going to issue the bonds below the face value. It means we got three options. Either we will issue the bonds at face value, or we will issue the bonds at what? Premium. Premium means say greater than face value, or we will issue the bonds at what? Discount. Discount means say less than face value. Understood how this decision is taken? And this working you are doing at the date of issuance or close to the issuance date. Okay, we assume here we are doing at the date of issuance. So guys, what we have to do to take this decision? Should these bonds be issued at par, premium, or discount? So first we have to compare two things. We need to compare which rate first? Stated rate. What was the stated rate? Which is mentioned on the bond. We will compare with what? With the market rate. Market rate is also called what? Effective rate. What's market rate? What is prevailing in the market? Market means maybe bonds market. Okay, so there you will have three scenarios. Number one, if stated rate, for example, you are offering how much percentage? 10%, is exactly equal to which rate? To the market rate. It means you are going to pay interest equal to the market rate. You are not going to pay more or less than market rate. If this is the scenario, bonds will always be issued at par value, at face value, and for this you don't need to do any calculations because par value will be given. Even if you will do the calculations, answer you will get equal to the par value. So no need to waste time. Scenario number two, if our stated rate, let's assume I'm assuming it is 10%, is less than what? Less than market rate. In market rate of interest is 12%, but we are offering how much percentage? 10%. So we are paying less or more than market? We are paying less. If you are going to pay less interest than market, so today you have to collect money less than face value. So that is why bonds will be issued at what? Discount, and this point requires calculations. Okay, then guys, scenario number three, if your stated rate is greater than market rate. For example, you are going to pay 10% and the market rate of interest is 8%. It means you will pay more than market. So it means today you can receive more than face. So here bonds will be issued at premium and it requires calculations. Okay, so whenever you will solve question, very first thing about initial measurement, you have to look at two interest rates. What is the stated rate and what is the market rate? According to that, you will solve the question. Okay, so how it is going to work now? Now guys, we are going to talk about, as I told you, if your stated rate is less than or greater than market rate, so it will be the case of discount or premium, right? And it requires what? Calculation. So that is why we are going to learn now how to calculate the amount of premium or discount. Okay, so it is very simple idea, guys. What we are going to do here, guys, simply we are going to calculate the present values. What we are going to calculate? Present values of future cash flows, right? That which we will discount at market rate. Maybe you are thinking what is saying, to decide the issue price, right? For example, if you are issuing bonds, first tell me what are the future cash flows which you will pay as a company or as an investor which you will receive. Number one, company will pay what? Interest every year or twice a year, right? Number two, what? At then company will return which value? Face value also. So these are the future cash flows which belongs to the bonds. What we are going to do, we are going to calculate the present value of future cash flows. Of what? Future cash flows. Like these cash flows, we are going to convert to the present values, to the today's values. Okay? And then these present values we will compare with what? With the face value. If present value are greater than what? Face value, it will be a premium. Don't worry, I will explain. I'm just giving you a rough idea. If present values are lower than face value, it will be a case of discount. Understood? So here I know most of the people, they don't have present values concept. Like what is the time value of money? You don't need to worry, even you don't know anything. I will just tell you what you have to do to solve the questions. That is only required. Because what is time value of money, you will study in future, obviously. Here, because we have to cover the topic. So shortcut, I will tell you like how to calculate present values, from where to take present value factors. Okay. So here we go, guys. In your exam questions, please focus with me. If in your exam question, if he is asking you to calculate what? Present values, you have to do this calculation, whatever we are going to learn. Or if he is asking you to calculate what is the issue price, same calculation you need to do. Or if he is asking you to calculate what? Market value of the bonds, same calculation you will do. Or if he is asking you to calculate what? Cash proceed, which you will receive at the time of issuance, same calculation you will do. It means they can use 4 words. So there are 4 terms are there which can be used interchangeably, right? Present values, or issue price, or market value, or what? Cash proceed. And you have to do what? Same calculation up to this only. But if he is asking you to calculate amount of premium or discount, then you need this whole format. Understood? Clear? First, you have to see what you have to calculate. If you are required to calculate present values, issue price, market value, or cash proceed, this will be your answer. That's it. But if you are required to calculate amount of premium or discount, then whole format you have to do this whole to get the amount of premium or discount. Understood? So here we go. First, we are going to calculate the present value. Okay, so you have to calculate a present value of 2 things. These 2 things. We have to calculate present value of the face value and present value of the interest. And we are assuming interest is paid annually. Because what to do with half yearly, I will tell you later. First, we are just talking about annual interest rate. So guys, here we go. For example, I'm just assuming here. Let's assume you have to take here first face value of the bonds. Face value of the bonds. Right? And this face value of the bonds, which you will return obviously at the end of maturity period. That is also cash flow. Right? So we will multiply always with what? With the present value factor. And this present value you will select always at which rate? Not at stated rate, at market rate. Because that is the benchmark with which we are comparing our stated rates. Now maybe you are thinking from where you will get the present value factor. Right? For this, you have to look in the table. The name of the table will be in your exam. This will be the name of the table. What it will be? It will be present value of $1 table. Present value of $1. This will be written as a heading. Okay? And how I will show you now. On your screen, you can see here. So here we have a heading of a table. This heading is called what? Present value of ordinary annuity. I told you when you need present value factor to multiply with the face value. From which table you will get? You will get from present value of $1 table. These tables will be available in your exam, right? So in your software, it will be available. But actually it belongs to time value money concept that I'm not explaining. I'm just doing what is required to solve questions relevant to bond. So here what we have to do, as I told you, you have to take present value factor. At which rate? At market rate, not at stated rate, at market rate. For example, in question he told you market rate is 10%. To look into this table, we need two things. What is the market rate? And second thing, we need to know what is the maturity period. For example, maturity period is 3 years. These two information we need to look into this table. So if you look at this table, on the bottom, on the top side, you can see horizontally what are written, percentages are written. And if you will look vertically, so what was written? Periods are written. 1, 2, 3, 4, 5, 6, and so on. Right? So now you have to select the percentage. What is your percentage? For example, assuming 10%. You will go to 10% column. Then you have to look to the maturity period. What is the maturity period? 3 years. So look, this is 3. So you will move to the 10% side. It means this factor we will use here. 0.751. How these factors are calculated? There is a formula to get the present value factor. Okay, but because the formula is, this is how it is applied. What is the formula to get these factors, whatever is written in the table? So this is the formula. So formula is what? 1 plus R. R stands for market rate raised to power minus N. Minus N means say number of periods, maturity period. Because you are not allowed to use scientific calculator in your exam. So that is why this table will be given. Because to solve this raised to power minus N, you have to use scientific calculator. Right? So that is why you don't need to memorize this formula. Just table you have to search. Table will be given in the question in the exam. So you have to use the values from that table. Understood? If your market rate is 5% and maturity period is 5 years. So what do you have to do? You have to go to 5% first. What is 5? Where is the 5% here? Maturity period is 5 years. Which value you will pick? 0.784. Understood? This value actually you will multiply with what? With the face value. With the face value. So going back to the slide number 1. So this is what I told you have to take when you calculate the present value. First you have to take what? You have to take face value of the bond, and then you have to multiply with what? PV factor at what? Market rate. So you will get one value here. Understood? And I would suggest you do the calculation for one bond first. Here put the face value of how many bonds? One bond. Because if you want to convert it to total later, I can just multiply, or we can just multiply with the number of bonds. You will get the total values also. Understood? Then what you have to do? Number 2. You have to calculate the present value of what? Interest amount also. And this interest we are assuming here per annum. And how first interest will be calculated? Just I told you before, you have to apply this formula, number of bond multiply by face value per bond, and you have to multiply with the stated rate. Don't multiply here with the market rate. Here you have to multiply with the stated rate. Make sure. And I'm assuming number of bond is what? 1. Face value of bond, let's assume 1000. Stated rate is 10%. I'm assuming just. So this is how you will get the interest per annum for one bond. Understood? That interest you will place it here. You will place it here. And then you will multiply with what? You will multiply what's it's written? Annuity factor. Right? Again, at which rate you have to look? Market rate. What is annuity factor? You can look in the table. Annuity factor, this I'm explaining from where you will get. The table heading is, a table heading will be what? Present value of ordinary annuity. From this table you have to look this annuity factor. Okay. So I'm going to show you that table again for annuity. So if you look, this is the heading what? Present value of $1. No, I don't need this now. I need the other table, which will have the name of this table. Present value of ordinary annuity. Again, to look into this table. So what you need first? You need market rate. I'm assuming market rate is 12%. And then second thing, you need to know what? Maturity period. For example, how many years? 5 years. It could be any interest percentage. It could be any number of years. Okay. So if you will look this table again, I will go to 12% column. And for 5 years, I have to look. This is 5 years. I will pick this value. 3.605. Understood? So from this table, you will pick and you will bring it to the main formula. So once you will multiply, guys, face value with the PV factor and market rate, interest with the annuity factor. So you will get here two present values, right? So these two present values you have to add. Okay, so this will give you what? What this will give you? Total present value of one bond. Why one bond? Because I have used the data one bond. Or it is also called what? Issue price of one bond. Or it is also called what? Market value of one bond. Or it is also called what? Cash proceeds. Now if you want to convert in totals, like in total market value of total bonds, or market value or present value of total bonds, or issue price of total bonds, simply this value you will multiply with what? Number of bonds. So you will get in total. Understood? Now, once you will get this present values, you have to compare with what? With the face value. Obviously, if this present value is for one bond, so I have to compare with the face value of the one bond. Right? Right or wrong? So face value will be what? Given in the question. Now you have to look if present values, I mean say this value. This is your present value. If present values are greater than face value, what? Greater than face. So this will be the difference will be the amount of premium. Okay. If present values are lesser than face value, so then this amount will be the discount. And if again I want to convert the premium or discount into total, I will multiply with the number of bonds. Okay, understood? I hope it is clear. So face value will be multiplied with the PV factor, and interest will be multiplied with the annuity factor. Understood? Now, what is the accounting entries? Guys, these three entries are written, but we can understand the whole concept by passing one entry. Okay, so what is the entry when you issue the bonds? You will always debit first cash, because you are going to receive cash against the bonds. So cash will always be debited with what? With the present values, because that is cash proceed which you are going to receive. Understood? And you have to credit what? You have to credit bonds payable as liability. Bond payable. So this bonds payable will always be credited with the face value. Which value? Face value, always par value or face value. And now, obviously, if your entry is not tally, so the difference might arise on which side? On debit side. If difference is on debit side, this will be what? Discount with the value of difference. Right? If difference is on which side? Credit side, this will be the amount of premium. Okay, with the difference. Understood? This is the entry which you will pass. Can you repeat entry with me? Debit will be cash. Always with which value? Present value. Credit will be bonds payable. Always with the face value. The difference will be either discount or premium. If the difference is on debit side, it will be a Discount, if it is on credit side, it will be a premium. Understood? This is the one way to get the amount of premium or discount. So here we go. Let's do one small example. Guys, here we have ABC company is planning to issue 10%, 6 years, 200 bonds with face value of 1,000 each. As I told you, this 10% is the stated rate, 6 years is the maturity period, 200s are the number of bonds. Face value is how much? 1,000 each. And interest is payable what? Annually. And market rate is how much? 12%. First tell me, is it a case of discount or premium? Simply your stated rate is less than market rate, because stated rate is 10, market rate is 12. Obviously, whenever this is the scenario, this is the case of discount. And this discount will arise. And when discount will arise, obviously, when your present value will be lower than face value. Right or wrong? This will happen. Now you have to calculate the amount of discount. So I'm doing calculation for one bond first, and then we can turn into total. So guys, first of all, I have to write what face value one bond. What's the face value one bond? $1,000. And this face value I will multiply with PV factor at which rate? 12%, which is market rate. This PV factor from which table I will look? Present value of $1. There. And what I will do? What is my market rate? 12%. I will go to that table, present value of dollar table. I will look at 12% for how many years? For 6 years, because majority is 6 years. At 12% for 6 years, you will find this factor there, 0.507, and you will multiply $1,000 with this. So you will get how much? $507. And then you have to calculate interest. Interest, how you will calculate? Number of bond multiply by face value per bond multiply by stated rate. Stated rate here. Number of bond is what? 1 I'm doing. Face value per bond 1,000 multiply by stated rate is how much? 10%. It's given here. This will give you interest how much? $100 per year. Right? You will multiply with what? Multiply by annuity factor. And this annuity factor at which rate? At market rate, which is 12%. Again, you will go what? Present value of ordinary annuity table. Look at 12%. For how many years? For 6 years, you will find this factor there. 4.111. Understood? Now you will multiply. You will multiply interest with the annuity factor. So you will get a present value. Right? So now what you are going to do, guys? Simply we are going to add these two present values. It is going to become present value of one bond, right? Do you want in total now? We can do in total. So we will multiply with what? With the number of bonds. Number of bonds are how much? 200. This will give you total present values, right? And this I will compare with what? I will compare with the face value of the bond. And face value for one bond is how much? 1,000 multiply by what? 200. This is going to give you how much? Total face value, right? Right or wrong? So your total present value and total face value will be this. Total present value will be 183,620, and total face value will be how much? 200,000. Now tell me, present values are greater than or less than the face value? Present values are less than, right? Because present values are how much? 183,620, and face value is how much? 200,000. So the difference will be what? Your discount, $16,380. And what entry you will pass now? You will debit cash. How much? with the present value. Present value is how much? 183,620. Credit bonds payable always with the face value. Face value is how much? $200,000. And difference you can see here on the debit side, 16,380, and this difference will be what? Debit to the discount account. Understood? This is what is called your initial measurement. Clear? Okay. Now, and I told you how to get the amount of premium or discount by using present values calculation, right? There is another way to get the amount of premium or discount, but you have to read the question very carefully to see which data is available to apply. Okay, so here we go. There is another way, guys. I'm going to explain also. These notes are important. Note number 1. This is the second way to get the amount of premium or discount, right? So guys, sometimes the issue price, which previously we were determining by using present values, sometimes this issue price is an exact percentage of face amount. What it means, for example, in these cases, bonds are said to be sold. He will tell you that bonds are sold at what? 101 or at 102 or at 100 or at less than 100, maybe 98 or 95. If bonds are issued above the 100, for example, you can see here 101 or 102, it is premium. If bonds are issued less than 100, like 95, 98, so this is called what? Discount. But point is that how you will get it. Right here, what you will do, you have to actually this is 101 or 102 means 101% of face value. This 102 means 102% of face value. If it is 95%, it means 95% of the face value. So it means how you will decide now issue price. Issue price. I'm taking this scenario. This scenario, bonds are issued at 101. So how I will decide issue price? I will take face value of the bond. Which value? Face value. Multiply by what? 101%. If I will do on calculator, this is the value which I will get. And this value is called what? Issue price. Now you want to calculate what? Premium. Premium, how you will calculate amount of premium? You will take issue price minus which value? Minus face value. Issue price is what? 1010. Face value is how much? 1000. Difference will be premium. It could be other way around. It could be discount also. What if bonds are issued at 99, for example? Bonds are issued at what? 99. So what I will do? I will take again issue price first. How? I will take which value? Face times 99%. So this will give you 990 as a issue price. Now I want to get what amount of discount. How I will calculate? Issue face value, which is what? 1000 minus what? Issue price, which is what? 990. So $10 will be the amount of discount. Understood? Whenever percentages are greater than 100, it is what? Premium. Whenever percentages are less than 100, it is always a case of discount. Clear? Understood? Answer is clear, right? Now, guys, this was what initial measurement, like initial entry, what we pass, debit cash, the present value, credit bonds payable with the face value, and credit what? Credit or debit will be the difference, either discount or credit. Right? So this was what initial measurement. Now, guys, I'm going to talk about subsequent measurement. So now we are going to talk about a bonds payable. Bonds payable. What we are going to talk about? Subsequent measurement. Initially, you will feel very hard. Maybe you will say it is very tough topic. but it will become very easy. So subsequent measurement is what? Like at balance sheet date. Which date? Balance sheet date. What changes you have to make, or how the bonds are recognized in balance sheet, and how the interest is recognized in the income statement. This is what we are going to talk about, and this is called what? Subsequent measurement. And these things you need to do at which date? At balance sheet date. Ready? So here we go. This is the formula first. Just forward, I'm explaining first. I will show you calculation, it will become very easy. This is the format for balance sheet presentation. And here we have a format for what? Income statement presentation. As I told you initially, you will see it is a bit more information. But once I will do calculation, it will become very short. Okay? So guys, how bonds are presented in balance sheet? This is the way you will use always. Number one, you have to take what? Total face value of the bond. Okay, that value we need. We will add. What we will add? What this word is written? Unamortized premium. Because premium is always more than face. That's why we are adding. But word is unamortized. Unamortized, how you will get? I will tell you later. But this is how you will get. You will take total premium minus what? Accumulated amortization of premium. So the remaining will be what? Unamortized premium. What is amortized? How to amortize? That I will tell you. But here just I'm explaining the format. If you have a discount is you always need to deduct. Right? And what amount you will deduct? Unamortized discount. And unamortized means the discount which is not yet amortized. Right or wrong? And how you will get? Again, you will take total discount minus what? Accumulated amortization. This will give you what? Unamortized discount. And same way you might have less. What? Unamortized debt issue cost, which is not in CMA, but practically is there. So how you will get unamortized debt issue cost? You will take what? Issue cost minus what? Accumulated amortization. You will get unamortized debt issue cost. So this will give you what? Carrying value of the bond, which will be reflected in the balance sheet. Understood? Just format I'm explaining. Then guys, this is for balance sheet. Just remember, I will keep applying this format during my session. Then we have a format for what? Income statement presentation. Okay, just look what's written here. It's written here, interest paid at which rate? That is your actual interest, right? Right or wrong? That you will take first. Then less what? Amortization of premium, annual amortization. In every year you are amortizing premium. So that will be deducted. Why deducted? Because premium is your profit. Right? You received more than par at the time of issuance. That is your profit. Now what? Once annually you will take this profit to income statement. It will reduce your interest expense. Understood? If you have a discount now. So what you will do? You will add what? Amortization or discount if you have. Why? Because discount was lost to you. When over the bond's life, you will amortize it. You will take it from the balance sheet to the income statement on a yearly basis. So this is your loss, which you are recording in income statement. This will increase your interest expense. Right? So this will be what? Interest expense at which rate at? It will be equal to interest rate at which rate? Effective. See, we started with which? Stated. It will end on what? Effective rate. Automatically. Now maybe you feel it is very hard. No, it's not hard. Because what we all need to understand here, we need to understand only amortization of premium and amortization of discount. With that help, we will also get unamortized premium, unamortized discount, amortized premium, amortized discount, accumulated amortization of premium, accumulated amortization of discount. Everything we will get. And what is amortization? I will explain also now. Understood? So first we are going to start with what? We are going to start with what? Effective interest method of amortization. This is the name of method. This is the name of method. Which method? Effective interest method. And this method will be used even to amortize amount of premium or to amortize the amount of discount. Which method we will use? Effective interest method we will use. And how it is going to work, this all theory I will explain with the help of calculation directly. It will be easy for you. Ready? Here we go. So let's do the example now. First, I'm going to start with the amortization of premium. Then I will tell you amortization of discount. That's it. So starting with amortization of premium. So guys, here we have example. First, I would request you please read the example from here only till here. That's it. You read the example? Okay, so here we go, guys. Again, we have a data here. On January 1, year 1. PINC, this is at the start of the year. Because we assume here bonds are issued at the start of the year. What changes are there? Bonds are, if bonds are issued between the year, it is another topic actually. But that we are not going to cover here. We are just discussing whatever is in your syllabus. So we assume bonds are issued at start of the year. Okay. So we issued the bonds. How many bonds? 200. These are number of bonds. At which rate? At 8%. This is stated rate. 5 years is what is your maturity period. $5,000 bonds. It is actually face value of one bond. Okay. When the prevailing interest rate in the market is how much? 6%. See, what's the stated rate? 8%. What is market rate? Tell me, is it premium or discount? Premium, because stated rate is greater than market rate. Whenever it is greater, it's a case of premium. So first we need to know what is the amount of premium. Then we will amortize, right? So first we will do basic calculation. So first I need to calculate what? Present values. What do we need to calculate? Present values. So here calculation we can do for the one bond also or total bonds also. So here we go, let's do for the total, because for one bond I told you, now I'm going to do for totals in shortcut. Guys, here first I need to write it here, what, which value? Face. Here I'm not going to calculate for one bond, I'm going to calculate for all bonds. Total face value, it means I need total face value here, right? How I will get total face value? How many number of bonds are there? 200. It's given here, 200. And what is the face value of one bond? 5,000. So total face value will be how much? 1 million. This face value you will always multiply with what? With the present value factor at market rate. And present value factor from where you will look? Present value of $1 table. And what is the market rate? 6%. Go to that table. Look at 6% for how many years? 5 years. So you will find this factor there. Right? Once you will multiply present face value with this factor, you will get present value of the face value. Now you have to calculate what? You have to calculate the interest. First calculate the interest. How you will calculate? You have to take number of bonds, multiply by face value per bond, multiply by which rate? Stated rate. Number of bonds are here how much? 200. Face value per bond is how much? 5,000. It is going to be total face value 1 million. Multiply by stated rate is how much? 8%. Stated rate is given here. This one. Right? So you will multiply with the 8%. So this will give you interest per annum how much? 80,000. Understood? Clear? So this interest I will write it here. Don't write interest for all years together. No, you have to write interest per annum only for all bonds. Okay, and then you will multiply with what? With the annuity factor. This annuity factor from where you will get present value of ordinary annuity table. Go there, look at market rate. What is market rate? 6%. What is maturity date? Years? 5 years. Go to 6% and 5 years. This factor you will find it. Understood? Understood? Then guys, you will multiply interest with annuity factor. You will get another present value. And now you will simply add these two present values. This is going to be your total present values for all bonds. This present value is also called issue price, cash proceed, or market value. Now, we can simply pass the entry. What was the entry? We will debit the cash. Always with what? With the present value. What's the present value? 1,084,247. And you will credit what? Bonds payable. Always with what? With the face value. Face value, how you got? 200 bonds. Number of bonds are there, and 5,000 for each bond is values there. This is 1 million. The difference is coming on which side? On credit side. What it is? It's amount of premium. Understood? This is initial entry. Now ready for amortization? And which method you have to use? Effective interest method. Which method? Interest method. Effective interest method. Here we go. What is effective interest method? Please listen to what I'm saying now. This premium, actually this both value are recorded in your balance sheet initially. In simple words, you have recorded this value in your balance sheet initially, right? Because you have to take face value plus minus unamortized premium or discount, which is equal to cash proceed. This value is recorded, but I have a quick question from you here. This premium, how much premium amount we have? 84,247. This we will amortize. Amortize means we will take out from the balance sheet and we will take it to the profit and loss account over the bond's life. Over the bond's life. Why? The reason, because this premium is for the bond. In 1 year, I cannot take whole amount. I have to take gradually over the bond's life. And second reason is that at the end, I will repay which value only? Face value to the investors. It means in my balance sheet, after 5 years, only face value should left. Right? Should be remaining. And that is why this value, the premium we have to amortize. Amortize means you will take gradually to the profit and loss account. This is what it means, amortization. And how it will be amortized, this format you will apply. Easy, no worry. Don't look just at the size of format. It's very easy. So first you will write here, always you will write here number of years. It's a maturity period. Maturity period is how many years are there? 5 years. You will place year 1. This is at the end of first year, at the end of second year, third year, fourth year, and fifth year. You will always start, you will always write first what's it's written? Beginning carrying value. Actually, we don't want. You can just put first year value as present values. Which value? Present values. Because what was the present value in my question? Present values were 1,084,247. Right? This present value we will write it here. And we will multiply with which rate? Effective rate. Don't multiply with their stated rate. You get amortization. Multiply with what? Effective. Okay. So this will give you, once you will multiply beginning carrying value with effective rate, this will give you what? Interest expense. What it will give you? Interest expense. Final value of interest, which will be recorded in profit and loss account. But I will apply format which I taught you earlier. Okay. Then from this interest expense, you will deduct. What you will deduct? actually what interest you have paid. And you have paid, what was total face value? 1 million. And what is the stated rate? Because this is your total face value and this is your stated rate. Actually, you are paying 80,000 per year. That I can place one time in all years amount. Now, the difference of interest expense and the actual interest paid is called what? Amortization of premium. The difference of these two guys is known as what? Amortization of premium. Right? Now, I will take beginning carrying value. What? Beginning carrying value minus what? Amortization of premium. I will get which value? Ending carrying value. Understood? Okay. This ending of the first year will be the beginning carrying value of next year. Again, I will repeat the process. Multiply by market rate. I will get what? Interest expense. So actually I paid how much? 80,000. Difference of these two is called what? Amortization of premium. Again, beginning minus this. You will get what? Ending carrying value. Again, this ending carrying value will be beginning for third. You will repeat the process. And at the end, what you will see at the end of the 5 years, you will have only face amount which is left in your balance sheet, which you have to repay. Understood? Now, first I'm telling you how to answer question in shortcut. Then I will tell you the format which I told you at start. How to apply that format. Ready? So here we go, guys. In questions, if he is asking you what amount of interest expense which should be reflected in profit and loss account, so your answer will be in this column. This interest expense. In year 1, what's interest expense? 65,000. In year 2, what it is? 64. In year 3, 63,000 something, and so on for every year. Right? Second question he will ask you. What is the amortization of premium in second year, for example? Amortization of premium in second year. So this is the amortization. Right? Second year, this is the answer. Fourth year, this is the answer. Fifth year, this is the answer. Right? And next question he can ask you. What amount of bonds will be reflected as liability in balance sheet? At the end of first year, what is the liability in balance sheet? This will be. At the end of third year, this will be. At the end of the fifth year, this will be. Now, it's easy to give answers, right? Interest expense, amortization are carrying value or closing liability values. You can look from this table. But now I'm just applying this format, what I told you. Do you remember what format I told you for interest expense? I'm doing this calculation for year 2. For which 2? For which year? Year 2. For example, you remember how you record the interest expense in profit and loss account? Profit and loss account. How? You will take interest at which rate? At stated rate plus amortization of discount minus amortization of premium. This will be your interest expense at which rate? At market rate, at effective rate, right? This format I told you. Are we dealing here with the discount or premium? Premium, not discount here. So that's why my interest at stated rate was how much? 80,000 yearly. So see, actual interest paid. Right? Now what is amortization of discount? I'm not dealing. What is amortization of premium in year 2? Amortization of premium in year 2. This is year 2. This is amortization of premium. How much? 15,842. Automatically it will be equal to interest expense at market rate. What is interest expense at market rate? This is interest expense at market rate, right? For year 2, 64,158. This is how you will present. Understood? Understood? Clear? Now I am applying balance sheet format for year 2. So what was the balance sheet format, guys? If you remember, balance sheet format, this was the balance sheet format. So you have to take what? Bonds payable at which value? Face value. That was how much? Year 2 I'm doing how much? 1 million. Then because I don't have discount, I have a premium. We have to add here which amortized premium, right? Right or wrong? Because I don't have a discount, I have a premium. So unamortized premium, how I will get? I told you have to take total premium minus accumulated amortization. This will give you unamortized premium. Total premium was, you can look from the first entry. Total premium was 84,000 something. First entry, look. This is the total amount of premium. 84,247. $84,247, right? From there you have to deduct accumulated amortization. How you will get accumulated amortization for 2 years, guys? Because you are dealing with second year. So these two you will be adding, right? Accumulated amortization. What is accumulated? Total amortization till date. If you will add these two values, can you help me please? 14,945 plus 15,842. 30,787. Can you deduct from 84,247? So this will be unamortized premium. 50? No. First one is accumulated amortization. Yeah, 53,460. So this, if you will add, obviously you have to add unamortized premium, you have to add, right? If you will add these two values, so this will be equal to this value exactly. Right or wrong? So which is how much? 1,053,460. So that is why I told you, you have a shortcut answer with you. These are the values which will be reflected in the liabilities. First year, this is the value. Second year, this is the value. Third year, this is the value. So this is the interest expense, which will be reflected in the income statement as a final answer. And these are the amortization premium and discount. Understood? Is it hard? No. Okay. Now, guys, we are going to talk about amortization of discount. So you have to keep in your mind. Again, same method we are going to use. Same effective interest method. And it will work in the same way. What will be different only? The difference will be amortization of premium we were deducting. We were deducting from the beginning. But amortization discount we will add. Right? But before moving to the discount side, we should know what is the entry for amortization premium. Entry will be this, guys. Every year, these entry you will pass. You will debit interest expense from this column. For example, first year, interest expense is how much? 65,055. Understood? You will debit premium because premium initially was credit. The first entry premium was credit. Now you are reducing every year. So you have to debit. And premium will be debited always with the amortization amounts. For example, this amount for first year, this amount for second year, third year, fourth year, fifth year. Right? We are dealing with first year, so this will be 14,495. And credit will be what? Cash, because interest which you have paid. And that will be what? 80. And that 80, it is actually this is the cash paid from this column. It means in the second year, what I will do? I will debit interest expense with 64,000. I will debit amortization premium of 15,000 something, and I will credit cash of 80,000. In last year, what I will do? I will debit interest expense with this value. I will debit amortization premium with this value. I will credit cash with this value. And final entry, once loan will be repaid. Loan will be repaid. So this liability is standing in your balance sheet, right? At the end of last year, this. What entry you will pass? You will debit the bonds payable and credit the cash because you are going to return the face value. That's it. Understood? Clear? That's it. Now guys, we are talking about amortization of discount. Right? Same way we are going to follow. So here we go. Let's do directly with the help of example. Okay. Now guys, let's do with the help of example now. So here we have amortization of discount. Please, I would request you to read this example from here till here. Just percentages we are going to change now. What's the difference here, guys? You have same number of bonds. Interest rates are swapped now, right? Stated rate became how much? 6%. Market rate is how much? This is market, 8%. Rest of the question is the same. It means whenever our stated rates are lesser than market rate, this is case of discount, because stated rate is 6, market rate is 8%. Right? It's a case of discount. So very first thing you have to calculate present values. Right? Present values how will be calculated? First take the face value. Face amount is how much? 1 million. How you got? Because number of bonds are 200, face value per bond is 5,000, it is 1 million. And this you will multiply with what? With the PV factor at market rate. Present value factor from where you will look? Present value of $1 table. And what is the market rate? What is the market rate? 8%. You will go to present value of $1 table. Look at 8% for 5 years. This value you will find it there. Just multiply and you will get present values. Now you have to put it here interest. How interest is calculated first? Interest, how it is calculated, guys? You have to take first. This is the interest calculation I'm showing you. You have to take number of bonds multiply by face value per bond and multiply by stated rate. Stated rate. Number of bonds are how much? 200. Face value per bond is 5,000. And stated rate is how much? How much? Stated 6%. So this will give you interest of 60,000 per annum. Understood? And this 60,000 you will multiply with the annuity factor. From where you will get present value of ordinary annuity table. Look at market rate. What's the market rate? 8 for how many years? 5 years. 5. You will find this value there. Right? Now multiply. So this will give you present value of interest also. And simply you will add these two present values. This is going to be cash proceed or total present values. Understood? Clear? What entry you will pass now? You will debit the cash will always with the present value, which is 920,146. Credit with the bonds payable always with the face value, which is how much? 1 million. Now difference is coming on debit side, which will be your discount. Understood? Clear? Now we have to amortize the discount. Ready? So which method again we are going to apply? Effective interest method. And same format we will apply. Don't forget your present values are here 920,146. So guys, effective interest method we are going to do. So this is here. You will put first year, you will write years here 1 to 5. Again, beginning carrying value. First value will always start with the present value, which was how much? 920,146. And you will multiply with what? With which always which rate? With the effective rate was how much? 8%. I hope so you are understanding, right? So once you will multiply these two values, this will give you what? Interest expense. And actually interest you are paying how much? 60,000 at stated rate. You remember we calculated above, right? 60,000 we are paying every year. Right? We will place all 60, 60, 60 in 5 years. Now the difference of interest expense and the cash paid is what? Amortization of discount. So now what we will do? We will take beginning carrying value plus amortization of premium. Oh, sorry. Amortization of discount. So you will get what? Ending carrying value. This ending carrying value will become beginning for next year. Again, you will multiply with the 8%. You will get interest expense. Actual interest paid is 60. Difference of these two is amortization of discount. Again, beginning plus amortization, you will get ending carrying value. And if you will repeat this process over 5 years, this is going to be equal to 1 million. So now point is that why we were adding amortization of discount? Because we want to move from 920,000 to the 1 million. That's why amortization we are adding. Understood? Now again, different question I'm asking. Question number 1. What amount of interest expense you will show in year 2? Go to year 2, this is the interest expense column. This will be the value. What is amortization of discount in year 2? Go to amortization, this is the value. What cash you will pay? 60,000. What is amount of liability in at the end of year 2? 948. Right? Now you can apply the format also. If you want me to apply how interest expense will be recorded in profit and loss account. I told you this is for income statement. I told you will take interest at which rate? At stated rate is 60,000 every year. I'm doing for year 2, guys. Again, you will take interest at stated rate which is 60. And I told you will add here amortization of discount you will add. And for year 2, what's the amortization of discount? 14,701. So this will be equal to interest at market rate, which will be how much? 74,701. Understood? Now how you will present in the balance sheet? What was the format for the balance sheet? This is for balance sheet now. What was format? You have to take bonds payable, which is 1 million, plus or minus what? Unamortized discount. Okay, because discount you are deducting. Unamortized discount, how you will get, guys? Total discount minus what? Accumulated amortization. You're sitting in year 2. Total discount was how much? 76,000 something in the first entry you can see. Total was here. Sorry, 79,854. This was total discount. 79,854. You have to deduct what? You have to deduct accumulated amortization for how many years? 2, because we are talking about 2 years. So this is the amortization column. I will add these two values. This is accumulated amortization. How much it is? 13,612 plus 14,701. 28,313. So once I will deduct, I will get unamortized discount. What it is? How much? 971,683. No, this 79,854 minus 28,313. 51,541. And deduct now what is your, it should be 948,458. Because this is the value of liability at the end of second year. Understood? Clear? This is how it is presented. So guys, I hope so it is clear. Please confirm through the chat option, is that clear? So guys, we are going to now discuss about how to deal with the bonds if interest is paid semi-annually. Semi-annually means after every 6 months. So this topic is also called interest on bonds paid more often than annually. Like semi-annually you are paying, like after every 6 months. Okay. If interest is paid twice a year, so what changes are there in calculation that I'm going to show you. Main things are not going to change, but obviously number of times interest is paid, it will increase, right? So here we go, guys. Whenever you are dealing with the bonds where you are paying interest twice a year, so you have to adjust for 3 things before doing any calculation. Okay, what do you have to adjust? For example, you have to adjust these 3 things. Let's assume in the question he told you maturity period is how many years? 2 years. Let's assume. And he told you stated rate per annum is how much? 8%. And market rate per annum is how much? 6%. And he also told you interest is paid every 6 months. So these at least 3 things you should adjust first. Because rates in the questions are quoted in annual terms. So you have to adjust for 6 months. So how you will adjust? Simply, if I want to adjust stated rate, I will take stated rate and I will divide. What I will divide? Number of times interest is paid in a year. How many times of interest is paid? 2 times. If I will divide, I will get half interest, which is 4% for 6 months. Understood? Then market rate you also need to adjust. Annual rate is 6. I will divide number of times interest is paid in a year. So which is again how many times? 2 times. So this will give you how much? 3%. And make sure and don't make mistake. What? So with maturity period, you will multiply, not divide. You will multiply number of times interest is paid in a year. How many times you are paying? 2 times. So this will give you 4 periods. Because look, logically, you have to pay interest 4 times in 2 years, right? That's why we have to multiply here. Don't divide. Understood? Now forget about these things, this, and you remember these things now. Now this is your relevant information. Maturity period is how many periods? 4 periods. I'm not using word 4 years. 4 periods. And stated rate is how much? 4%. And market rate is how much? 3%. This is your relevant data now. Understood? So how you will do the calculation now? First of all, how do we calculate the present values, which is also called issue price, market value, or cash proceed. I will take it here face value. Don't make it half. Huh? For example, if you are going to repay $1,000 after 5 years or 2 years or 4 years, put it here $1,000. Multiply by. Here you have to make changes. What? Present value factor at which rate? Market. What I have assumed market rate there? We assume market rate is 3%, right? And maturity period is 4. And stated rate is 4. So market rate is 3%. So what I will do, I will go here. Present value factor at market rate. Market rate was how much percentage? 3%. I will look for 3%. And periods were 4 periods adjusted, right? I will simply go to present value of $1 table. I will look at 3% for 4 periods, because on the vertically it's written 1, 2, 3, 4. So those are periods actually. Okay, you will go to the 4 periods and pick the factor from there. Understood? Second, you have to take interest. First, interest, how it will be calculated? How? We will take number of bonds, multiply by face value per bond, and multiply by stated rate. What's the stated rate? 4% in my example now. Adjusted rate, right? 4%. Understood? So I will multiply with the 4%. So I will get interest amount here. Clear? Then I will multiply with what? With the annuity factor. Understanding? Annuity factor. How I will look annuity factor again at market rate. Market rate again, how much percentage? Market rate is 3. 3% is my example. Okay, I will simply go to present value of ordinary annuity table. I will look at which percentage? 3% for how many periods? 4 periods. I will pick the value from there. Right? And I will multiply, I will get 2 values. So this is going to be your total present value. Understood? So it means only 3 things you have adjusted. What? Maturity period, market rate to half year, and stated rate to the half year. So adjusted data is relevant now. That's it. Understood? So screen is visible, right, guys? Okay. Clear? So this is how you will deal with it. So let me show you example. Same entries you will pass. Debit cash always with the present value. Credit bonds always with the face value. And if difference comes on debit side, it will be a discount. If it comes on credit side, it will be a premium. And then you have to amortize. And you will amortize over how many periods in my example? 4 periods. And effective rate is 3%. Stated rate is 4% in my example, right? But I'm going to do the examples, whole example. Okay, from scratch till the amortization. You can see the difference, what are the changes. There we go. So we have one question, guys, here. I would request you to read this data from here till here. Just go through this data first. Credit. So what is the question here, guys? On January 1, year 1, EVA company issued how many? 5 years, 6%, 100,000 bonds. Obviously, 100,000 cannot be the value for one bond. It is total value. Okay, up to 5,000, we can assume it is for one maybe. 100,000 is not possible, right? We'll assume it's a total face value. Bond pay interest what? Semi-annually on July 1 and December 31st. Like after every 6 months, you are paying interest. The bonds issued to yield 10%, like it's like a market rate. An investor rate of return. It is market rate, which is how much? 10%. Okay, now, so tell me, guys, what to do. These bonds should be issued at par or premium or discount, because stated rate is 6, market rate is 10. So it means stated rate is less. Bond should be issued at discount, right? But adjust 3 things I told you. What to adjust 3 things? Stated rate. Stated rate was how much? 6%. You will divide with the 2 times. It will give you 3%. Adjust the market rate. Market rate is 10%. Divide with the 2 times. It will be 5%. And adjust the maturity period. It was 5 years. Multiply with the 2. It will be 10 periods. So this is the relevant data for you now. Right? Understood? Forget about other everything now. This is the relevant data. 3% is which rate? Stated. Market rate is 5 and maturity period is 10. Right? Let's do the present value calculation now. How you will calculate present values? First, I am calculating present value of face. Face value is how much? 100,000. I have to multiply. What was market rate? Adjusted. What was market rate? Market was 5, right? Yeah, 5. And maturity period is 10 periods. What I will do, I will write this face value, which is 100,000, and I will look at which rate at 5% at how many periods? 10 periods. And which factor? Which table? Present value of $1 table. Go to 5%, look for 10 periods. This value you will find it there. Okay, you will multiply with face, you will get one present values. Understood? Then second, you have to calculate what? Interest. What is total face value? And what is stated rate? Stated rate is 3%. So this will give you interest for 6 months, right or wrong? Understood? Now this will be multiplied with what? With the annuity table, annuity factor. Annuity factor, again you will look at market rate. What is market rate? 5% for how many periods? 10 periods. But in the annuity table, so there you will find this value. So this you will multiply with this now. This will give you total present values, right? So we have a total present value of face, total present value of interest. It is going to be total present value of both. How much? 84,566. Understood? Is it premium or discount? Discount, because present values are lower than face value. Face value is 100,000 and present values are 84. So it is a difference is discount. Now pass the entry first. What will be the entry first? Debit will be cash, always with the present values. Credit will be bond payable, always with the face value. Difference is on debit side, which is your discount. And this discount will be amortized. And don't forget adjusted rates. What are the adjusted rates? Stated rates. Stated rate was 3%. Effective rate is 5% and periods are 10. Right? This data I will use to amortize. And what I will do now, I'm going to show you table now. And my total present values are how much? 84,566. So 10 periods I'm going to solve now by using effective interest method. So these are the 10 periods. Understood? We will write first period 1. Period 1 say first 6 months. Period 2 means say next 6 months. Period 3 means say next to next 6 months, like that. Understood? So, but you have to write how many periods? 10 periods. So I'll start calculation with what? With the present values. What's the present value? 84,566. And I'll multiply with what? With the effective rate, adjusted effective rate, which is 5%. Right? I will get what? Interest expense. But actually interest I'm paying how much? 3,000. Do you remember stated rate 3% of $100,000? This will be interest. 3,000. So difference of these two, it's interest expense and cash paid, will be your amortization of discount. Right? Right or wrong? Now beginning carrying value plus amortization. This will be ending carrying value. This ending carrying value will be the beginning for next times again 5%. You will get interest expense. But interest is paid how much? 3,000. Difference of these two is amortization of discount. Again, beginning plus this, you will get ending carrying value. You will repeat this process over the 10 periods and at the end it will be $100,000. It is some difference, it's coming due to rounding off. Understood? Okay, now I'm asking question. What is, see, it's your presence of mind I'm checking. What is the amortization of discount in the first year? First year amortization of discount. In first year, how many periods will be there? 2 periods. So this is the amortization of discount for the first period. Right? What is the amortization of discount for first 6 months? For first 6 months, this will be the answer. But for the first year, this will be the answer. First year, this will be the answer. Right? What is the amortization of discount for second year? These two. Third year, these two. Fourth year, these two. Fifth year, these two. Right? What's the interest expense in the first year? Interest expense. Interest expense of second year. Interest expense of third year. Interest expense of fourth year. Interest expense of fifth year. Can I ask another question now? What is the liability value at the end of first year? Don't make explanation now. At the end of first year, this is the end of the first year. This is liability value. This is the end of second year. This is the end of third year. This is the end of fourth year. This is the end of fifth year. Understood? Clear? Entries you will pass the same. Debit interest expense in the first year with this value. Debit, a debit, if interest expense is debit. So credit will be cash with in the first year with this value, right? And credit will be discount amortization with this value in the first year, right? Same entries as you were passing previously. Same entries you will pass. Understood? I hope so it is clear, right? Now, last 2 to 3 things I'm going to tell you. Sometimes, guys, it is just a small calculation because maybe you need it. This data issue cost you don't need to study. I'm just moving here. Okay. So here we have some other just information to discuss because you might have very simple questions also. Right? It's relevant to bonds and notes. So for example, sometime you might issue a bond. You might issue a bond. For example, maybe you issued a bond for 1 year, or you might issue bonds against inventory, against purchases, right? For example, I bought a goods from you for $1,000. I gave you a bond, right? And I told you after 1 year I will make payments against this bond, which was issued against the inventory, right? And I will pay interest only one time. So this is called only one principal payment. It's this bond is called which bond? Term bond. What is term bond? One interest you are going to pay. Okay, our interest is paid at specific date only. Okay, so how you will deal with it? So let's do with a small example. Right? So please look at it. It is similar to the bond accounting, nothing different. Nothing is different. For example, we assume here, because with an example you will understand it better way. So guys, here we have an entity agrees to give in return for merchandise a 3-year $100,000 note bearing 8% interest, paid annually. Simply you bought a goods for $100,000, you gave a bond, and that bond is having 8% interest. This bond is for how many years? 3 years. The effective interest rate is how much? But what is stated rate? It's similar like normally you will do for bond accounting. Stated rate is how much? 8. This bond is for how many years? 3 years. But effective rate is how much? 6%. This bond should be issued at premium, and premium needs to be amortized, right? You are understanding what I'm saying? It's similar bond, but word they used only notes. Same accounting you will do. There you received cash when you issued. Here you are receiving inventory when you issue the bonds. Cash will be replaced with the inventory only. So let's see. Let's do the example because I'm trying to just discuss orally. Then effective interest is 6%. So because the note is stated rate exceeds the effective rate, because stated rate is 8%, effective rate is 6%. The note will be issued at premium. So same way you will calculate the present values as we have calculated previously. You will take present value of the face, then present value of interest. Face is how much? $100,000. Interest how you got? Face value which is 100,000 multiplied by stated rate which is 8%. So this is 8,000, right? So you will interest this factor how you selected. You selected at market rate for how many years? 3 years from $1 table and from ordinary annuity table. So you got it here what? Total present values. And what entry you will pass? Debit inventory, not cash. Right? With the present values. Credit what? Note payable with the face, and credit what? Premium. And premium you can amortize, right? Same as we have done previously. Right or wrong? Because don't mix it. Don't think it's a different thing. It's the same thing. It's not different. Even you're issuing notes. It's similar to the bonds. Just what we did here, we replaced the word inventory with cash. Otherwise, similar procedure will follow. Clear? Is it new? No. You know it. Now, there's a one scenario, guys. Look this example, because every scenario you should remember in your mind. This is another thing. Sometimes we take loan. I'm dealing with loan, right? Sometimes we take loan. So what we might have, because we know whenever we take loan, we need to pay what? Installments. And how installments is always there? In installment, there could be amount of interest, there could be amount of principal. This is how we are paying installment, right? Sometime your lender, you will maybe initially you will feel what I'm saying, but once I will show you example, you will realize what I was saying. Sometime your lender will tell you that in every installment we are going to fix $2,000 of the principal, plus you have to pay what? Interest. Here what is going to be fixed? Principal amount is going to be fixed, plus interest you have to pay. So this is how your installment will become, right? Understood what I said? In some scenario, again let me write installment, which includes what? Interest and principal. Sometime what is fixed? Installment is fixed, right? And then once you will break the installment, it will become what? Interest and principal. Or another scenario, sometimes interest is fixed. The difference of interest and installment will become what? Principal settled, but principal is not fixed here. It is hard, I know, but if I will show you example, it will become very easy what I am saying. So here we go, let's do the example. Ready? Because this kind of question can be given in the question exam, and maybe he will ask you to calculate interest expense or amount of installment or principal settled value. So here we go. On January 1, year 1. As company borrowed $120,000, we took a loan. At which rate? At 10% note payable to our bank. 3 equal annual principal payments. What is fixed here? Principal payment is fixed 40,000. Plus you have to pay interest are paid at the beginning of 31st December year 1. Like yearly you have to pay interest. Understood? So how you will do it now? You will write it here, how you will deal with this loan. We'll write first year. How many years are there? 3, because 3 equal principal amounts you have to pay. I will start first total amount of loan. It was how much? 120,000. And I will multiply with the agreed rate. Agreed whatever I have agreed with the bank. That is 10%. This will give me what? Interest amount. But my principal amount is fixed how much? 40, 40, 40 for 3 years. So what is my first installment? 12,000 plus 40,000. This will become my installment. Right or wrong? How I will get closing liability? Opening value minus principal settled. Which value? Principal. This will be my ending liability. Right? Understood? Because opening principal minus principal settled should be ending liability. This ending liability will become opening for next year. Again, times what? 10%. This is going to be interest, but my principal amount is fixed. So 8 plus 40, it will be 48,000. Right? And then opening minus principal. Opening minus principal. It is ending. Then this will become again opening, again times 10%. What is my interest? 4,000, but my principal amount is fixed. So 4 plus 40, third installment will be 44. So beginning minus principal settled. It will be ending 0. Right? What was fixed here? Principal. And remember, installment will always be interest plus principal. Now look another example. Here, what is going to be fixed? Installment is going to be fixed, not the principal amount. Installment, right? So look, read this example, please. I'm reading. on January 1, year 1. S borrowed how much? 120,000 on a 10% note payable. 3 equal annual payments of how much? 48,254 are decided. Obviously, it is not principal, because if it is principal, amount total loan is 120. Principal should be 40, 40, 40 equal. But it is 48,000 something. Obviously, it includes interest. Here, principal amount you need to find out. How much principal you are paying with every installment. So what you will do again, you will write year, first year, you will start with the amount of loan, which is 120 times what? 10%. This is the amount of interest. And here I'm putting now what is fixed? Installment. So difference of installment and interest will be principal, right? Right or wrong? Right, sir? If I will take amount of installment, from there if I will deduct interest, what will be remaining? Principal. So opening minus principal, always minus principal, will be ending liability. This ending will become opening for next year again times 10%. It will give you interest. Again, what is my fixed? Installment. Difference of interest and installment, it is going to be principal. Right? Opening minus principal, it will be ending. Then what? Third value, guys. This ending liability, this is going to be opening for third year again times 10%. This will give you interest. Again, what is fixed? Installment. So difference of installment and interest is going to be principal settled. So opening minus principal, it will become 0. Right? Now what accounting entries you will pass? Obviously, when you took the loan, you have to debit here, especially in these two cases, what I've discussed here. Well, like where principal was fixed or where installment was fixed. So what first entry you will pass when you take the loan? Debit cash and credit note payable, because you have given note. Right? For example, 120,000, 120,000. And year end entry, what you will pass every year? Because first you need to prepare this schedule, you know. So you will debit what? Interest expense. From every year you will pick the value. Right? You will debit what? This note payable. Note payable with which value? With the principal value. Right? And you will credit what? Cash. With which value? With the installment value. Understood? Clear, guys? I hope so it is clear.